Hello everyone. Today we're going to have a new chapter, Net Present Value and Other Investment Rules. So first of all, what is net present value? Suppose you have $50 to invest today and you can receive $60 in a year. What is our increase in the value given a 10% expected return? So 10% here is a discount rate. Basically, we have to calculate the profits, which is the difference between the money you get and the money you invest. But the $60 you get is from a year in the future, which means we cannot directly add them up. So $60 will be discounted at 10%. So 60 divided by 1 plus 10%. We calculate the present value of the $60 as today's value. So that is your total cash inflow. What is your cash outflow? The cash outflow is your investment today, the $50. So that is why there is a negative sign in front of the $50 because this is a cash outflow. So if you add them up, the profit is $4.55. That is our definition of the net present value. If you look at the barcode here, the green one is your initial investment, which is $50. The purple one is the value added, $4.55. That is the definition of net present value. So basically, the net present value is the difference between the market value of a project and its cost or its initial investment. Okay, so basically, the net present value asks how much value is created from undertaking this investment. The first step, we need to calculate the expected future cash flows. Second, we need to calculate the required rate of return, which is the discount rate. So the third step and the last step is to find the present value of all the future cash flows minus your initial investment. So why should we use net present value? Because we should accept all positive net present value projects because they will benefit shareholders. Because the net present value use all the cash flows and discount them properly. So if the net present value is a positive number, it means the project will bring positive profits to the shareholders and you should do the project. So the net present value rule is now if you have a lot of different projects to choose, what do? Well, first of all, you should accept all positive net present value projects. If there are more than one, and you can choose the highest net present value. Okay, so suppose you have 100 projects. 50 of the projects have positive net present value, means those 50 projects are possible choices for you. But if you can only pick one, which one do you pick? You should pick the one with the highest net present value because that is the project giving you the highest profits. So here is a formula for the net present value calculation. It equals C0. Most of the time C0 is a negative number because this is the time zero. Okay, so this is the investment you have to make at time 0. Then in the future periods, most of the time you will have positive cash flows. Note the difference of the net present value and the present value in chapter 5 and 6 is here we have to consider your initial investment, right? If we get rid of the C0 here, that is exactly the multiple cash flow formula for the present value. So that is the only difference between the net present value and present value. The difference is C0. We have to consider your initial investment. Okay, throughout the chapter, I'm going to use two examples. One is this rental project example. Another one is the car manufacturer example. I'm going to use the pictures to show which example I'm talking about. So if you see this picture, the high building, we are talking about the rental project. Okay, so now you have the opportunity to purchase a rental building and you have a tenant lineup that will generate $16,000 rental income each year for the next 3 years. At the end of the 3 years, you will sell the building and you expect to sell the building for $450,000. How much are you willing to pay for the building right now? Okay, now assume you have a 7% opportunity cost of capital. Well, what is the maximum amount of money you are willing to pay for it? Well, first of all, we have to estimate all the future cash flows. We have a tenant lining up. Each year, the tenant will pay you $16,000 rent in year 1, 2, and 3. Okay, so in year 3, you will have the last rental income of $16,000. At the same time, you can sell the building for $450,000. If you discount all the 3 cash flows at 7%, discount all of them back to the present value as of today, then you add them up. So the present value of the all future cash flows is $409,000, which means this number is the maximum price you are willing to pay for the building. Okay, so that is the maximum price you are willing to pay based on your personal calculation. Now suppose there is a price tag for the rental building on the market. So the building is on the market for sale for $350,000. Would you buy the building or not? Well, let's calculate the net present value of the rental building, right? Now suppose you pay for the price tag, okay? You pay for the tag price, which is $350,000, your initial investment. That is why there is a negative sign in front of it, plus all the future cash flows discounting back first year's rental, second year's rental, last year's rental plus $450,000 selling price. You will have a positive net present value of $59,000, which means making this investment is profitable. If you do it based on your personal calculation, you can make about $60,000 profit. We should accept it because the net present value is positive number. Okay. So how do you do it in a calculator? So here in this slide, I showed you the basic buttons to click when you calculate net present value. But I also upload a YouTube video on the website on the Blackboard. You can watch the video which shows you the steps how to calculate the net present value. Now we're moving to the second project, which is the car manufacturing new project, which is identified by the new red car here. So whenever you see this picture, we're talking about a car project. Now you are reviewing a new project to produce cars, and you have estimated the following cash flows. To make this investment, the year 0, which is today, you have to make an investment of $165,000. In return, in the following 3 years, you are expecting the following cash flows: $63,000 in first year, $70,000 in second year, $91,000 in year 3. And at the same time, your estimated net income number is the following for the next 3 years. And you also have the average book value of $72,000. Those are the information we have when you are evaluating the project. And we also know the opportunity cost or the discount rate or the required rate of return is 12%. Now, let's calculate whether we should do the project or not. Using the formulas, first of all, we calculate the net present value, right? Your initial investment is $165,000, which is a negative number because it's a cash outflow because you have to make an investment. And then we have to discount all the cash flow back at 12% rates. Here, I want you to pay attention. Look at what numbers we are using. We are using the cash flow numbers, okay? The cash flow numbers. We never ever use net income numbers directly from the income statements, okay? Because the net incomes, they do not reflect the true cash flows. For example, when you calculate the net income, you have to consider the depreciation. While depreciation is a counting number, although you can deduct depreciation from your net income, but that depreciation is not a real cash outflow, right? Because you already deduct all the cash flows at year 0 when you make the investment. It's just the IRS will never allow you to deduct all your investment in the first year, right? The IRS will ask you to spread out your investment through depreciation over the following years. So you never ever use the net income number in calculating the net present value. When you're calculating the net present value, always use the cash flow numbers. Okay, so you want to discount back all the 3 years cash flows accordingly at 12% discount rate. And your net present value is $12,000, which is a positive number, and you should go ahead and do the project. The second way is to use the calculator. Again, watch the videos on YouTube. Get very familiar with your financial calculator. You should get exactly the same number, $12,000. And yes, we should accept the project because the positive number. Okay. So after the net present value, which is the most important investment tool to use, our second tool to make investment decision is called payback period. So what is payback period? The payback period is how long does it take to get your initial cost back in a normal sense. In a normal sense means you do not consider discount. Okay. All right. So the computation is very simple. You estimate all the cash flows and you subtract the future cash flows from the initial cost without any discounting until the initial investment has been recovered. So this is the only place you don't have to consider discount, okay? Only when we are doing the payback period, you don't consider discount. That is the only place you do not consider discount. In all other calculations in this textbook, you have to consider discounts. The decision rule is very simple. Accept the payback period if it's less than some preset limits or cut off. Okay, again, we're back into the car example. Assume we will accept the auto project if the payback is within 2 years. Okay, so 2 years. 2 is a very subjective number. Who set the rules of 2 years? Okay, the financial managers can set the rules. If you're working for a car one company, the financial manager may set a 2 years rule. The financial manager will say we can only accept the project if we can cover our initial investment in 2 years. But if you're working in a second car company, the car two company's financial manager may set a more relaxed rule, say 3 years, which means if we can recover the project in initial investment in 3 years, we can accept the project. So you can see the number of the cutoff for the payback period is very subjective. Different managers can set different cutoff values. So here we have 2 years. Now assuming that this financial manager prefers 2 years, he prefers liquidity. He wants to get his initial money back within 2 years. Let's see whether we can do this project. Initially, you invest $165,000. In the first year, you have the $63,000 cash back, which means you have about $100,000 still need to recover. In the second year, you can recover, so that $70,000 is the cash flow in year 2. So the remaining cash flow minus second year's cash flow, you still have $31,000 to recover. Only until year 3, with $91,000 cash flow in year 3, you finally recover your initial investment with a profit of $60,000. But shall we accept or reject the project according to the payback rule? Reject, because the project takes about 3 years to cover your initial $165,000 initial investment. While the financial manager prefers liquidity, He wants the project to pay back the initial investment in 2 years. So, according to this particular rule, we cannot accept the project, even though the net present value is a positive number. But because of the liquidity concern, the manager can still reject the project. Okay. But there is some problems with the payback method. So let's take a look at the following 3 projects. We have project A, B, and C. Let's take a look at the cash flows. All 3 projects involves $2,000 initial investment. So that is why C0 is minus $2,000 for all 3 projects. Let's take a look at the cash flows. Project A has $1,000 in year 1, another $1,000 in year 2, and $10,000 in year 3. Project B, $1,000 in year 1, $1,000 in year 2, 0. Project C, 0, 2,000, 0. Let's check the payback period. All 3 projects have payback period of 2 years, right? Because 1 plus 1, $2,000. You covered your initial $2,000 in 2 years. 1 plus 1, $2,000. You covered your initial investment in 2 years. $2,000, you covered your initial investment in 2 years, right? Okay, so according to the payback period, we should accept all the projects because the manager says as long as the payback period is 2 years, we can do the project. But let's take a look at what is the net present value at 10% discount rate. Without even doing the calculation, I know project A is going to have a very positive net present value because of this big lump sum payment at year 3. While project B and C will have negative net present value, right? Because if you discount the future cash flows, that will be a number smaller than $2,000. Let's do it. I was right. The net present value for project A is very positive, $7,000. But for project B and C, you actually have a negative present value project, which shows you shouldn't even do the project B and project C. So basically, one problem with the payback period method is it didn't consider all the cash flows after your subjective cutoff period, which is 2 years in this case. And also, you could have a negative net present value, right? If that is the case, even though project B and C are within 2 years, you should never do the project because of the negative net present value, okay? So whenever the payback period and the net present value criteria are giving you conflicting signals, you should always go with the net present value because positive numbers shows you will make a profit, while negative number shows you will actually incur a loss. Why should you do so? Okay. The disadvantage of the payback period, of course, it ignores the time value of money, right? That is the biggest one. And also, it ignores the cash flow beyond the cutoff days, as we showed in the previous example. It is biased against the long-term projects because, remember project, if the cutoff value is 2 years, imagine a long-term project for 5 years. Even though you can have a big lump sum payment in year 5, the managers will never consider that project. And it also requires a very arbitrary cutoff point. Why should you set the cutoff as 2 years? How about 3 years, 5 years, right? It's very subjective. Okay, and also a project accepted based purely on payback period can have a negative net present value, which you cannot do it anyway. Okay, of all these disadvantages, why should we still use payback period? Well, first of all, it's very easy to understand and it's very easy to calculate, right? Sometimes by just looking at the project, you have a very good idea like how long you can take your initial investment back. And the best advantage of the payback period is it will give you the buyers toward liquidity. So if you set a payback period as 2 years, 3 years, means the project is going to be very liquid. It takes a very short time to get your initial money investment back. So a lot of the managers prefer liquidity. A lot of the managers cannot afford to wait for a long time for the project to make profits, especially for the small size companies. And it also adjusts for uncertainty of the later cash flows, because if you cut off, so if you um, thinking about a 10-year project, if something goes wrong in year 8 and year 9, it can dramatically change your net present value number, right? But if you set the cutoff very short, say 2 years, 3 years, well, you reduce the uncertainty in the future. Well, the discounted payback period will consider the time value of money, because the payback period, the biggest drawback is you just add all the cash flow up without discounting the future cash flows. How about we actually calculate discounted cash flow in the future and then add them up? Well, that is perfect. But when you do that, when you discount all the future cash flows and then you add them up, you already have the net present value. Why should you even bother, right? So that is the problem. But here, anyway, the decision rule is accept the project if it pays back on a discounted base within the specified time. Okay, the textbook has a detailed calculation on discounted payback period, but in this course, this particular course, I will not require you to calculate the discounted payback period, because in the real life, not really many people use that. Okay. But anyhow, I still show you how to calculate the discounted payback period. Basically, you do exactly the same as you did before with the regular payback period. The only difference is now all the future cash flows are going to be discounted according to the period you receive them. Okay, so again, the project pays back in year 3, and according to our 2-year cutoff, you still reject the project. Okay, so the discounted payback period, the advantage is it includes time value of money, also easy to understand. And another advantage is because now you consider the discount value, you will not accept negative net present value anymore. Again, the advantage is you are biased towards liquidity. Well, the disadvantage is it requires an arbitrary cutoff point, and also ignore all the cash flows beyond the cutoff points. And it again biased against the long-term projects. Okay. All right. So the first one needs a little bit discussion. It may reject positive net present value investment. What does that mean? If you still recall our previous example, this one. Okay. If we look at this one, the project A has a positive net present value, right? Okay. If you use the discounted cash flow numbers, let's see, okay, if you set the cutoff as 1 year, for example, say, I need 1 year to recover my initial investment, then we should not accept project A. But you see, project A has a very positive number, okay? So when you're calculating the discounted payback period, there is still a chance you are rejecting a very positive net present value project. Okay. So finally, we have the average accounting return. So the average accounting return is the average net income divided by average book value. Okay. The decision rule is we accept the project if the average accounting return is greater than a preset rate, means a cutoff rate. What does that mean? Okay. Again, our car example. The average net income will be the average net income of the 3 years, which is $55,000. The average book value is given $72,000. So the average accounting return is 21%. Well, if the manager set a 25% return as the minimum acceptance rate, should you accept or reject the project? You should reject, because the project also only pay you 21%, which is less than your required rate of return. Okay, so the advantage is, the biggest advantage, that is I think the only reason people are actually using it is very easy to calculate. You don't really need to estimate any information at all. All the informations are easily available from the financial statement, right? The net income numbers you can directly copy from the income statements. While when you're doing the net present values, all the cash flows has to be estimated by yourself. Okay? The disadvantage is, of course, that is why it is not a very popular method. It is not a true rate of return. Time value of money is again ignored because we didn't discount anything at all. Also, it also requires a arbitrary benchmark cutoff rate. In our previous example, the cutoff is 25%, which is very high, right? If you have a second manager coming in, if the manager set the cutoff rate as 15%, then this is a perfectly good project to go. And finally, the number based on the accounting net income and book values, not cash flows and market values. Okay, so the real cash flows and market values are more relevant in terms of the calculation. Okay, so now the internal rate of return is another very important investment rule we're going to learn. So in this chapter, the most important one, and everybody use, is the net present value. The second important investment rule is the internal rate of return. Most companies will use both of them at the same time. Okay, so what is internal rate of return? Internal rate of return is the discount rate that sets the net present value to 0, which is the most important alternative to net present value. It means it's more important than the payback period, more important than the accounting rates of return, more important than the discounted payback periods. So how do we use it? The minimum acceptance criteria is accept if the internal rate of return is higher than your required rate of return. Ranking criteria. If you have 100 projects with 100 internal rates of return, which one do you pick? You pick the highest one, just like the net present value. Okay, so now let's go back to our rental building example. See this picture? We are back to the first example. All the numbers are exactly the same, and let's calculate internal rates of return for this example. Okay, by definition, the internal rate of return is the discount rate that set the net present value to 0. So if we set the net present value to 0, the net present value formula is your initial investment plus all the future cash flow discounted to time period 0. Okay, you back out the number, which is 13%. Okay, so here's the tricky part. With a regular calculator, it's going to be extremely hard to calculate the internal rate of return. But can you still do it? Yeah, you can still do it. As I said before, you just need to randomly pick a number, plug it in, and try if it works. If it doesn't, increase or decrease the number. Okay. But with the financial calculator, it's just a couple of clicks away. So the internal rate of return is 13%. Should you accept it or not? It really depends on what is your required rate of return. Okay, if the required rate of return is 15%, you do not accept it. If the required rate of return is 10%, which is again set subjectively by the financial manager, you should accept the project. Okay, so let's look at this picture. If we plot the net present value on the vertical line against internal rates of return on the horizontal line, because a horizontal line here is the discount rate. We know there is an inverse relationship between the net present value and the discount rate, right? Okay, so the higher the discount rate, the lower the net present value. Okay, all right. So the internal rate of return is the one that set the net present value to 0, which is the crossover point right here, 13%. Okay, it means above 13%. If the required rate of return set by the manager is above internal rate of return, the net present value is going to be negative. You shouldn't consider the project. If the required rate of return is below 13%, the net present value will be a positive number and you should accept it. Again, in this slide, I showed you how to calculate internal rate of return using the financial calculator. And you can also watch the videos to get yourself familiar with the process. Okay, so let's go back to the car example again. Let's calculate internal rates of return in our auto project. You have two ways to do that. Using the formula. Again, you set the net present value to 0, back out the internal rates of return. Or using the calculator, calculate the internal rates of return. Both of them will give you the same number, 16.13%, which is higher than the 12% required rate of return. Should you accept or reject the project? Accept, right? Because the calculated internal rate of return is higher than the financial manager's cutoff value, which is 12%. Okay, so if you plot the net present value against the discount rate for the car project, the internal rate of return or the discount rate that set the net present value to 0 is 16.13%, which is our internal rate of return. If the manager's required rate of return, which is 12% in the previous example, you will have a positive net present value and you should go for the project. If the preset or required rate of return is higher than internal rate of return, say 18%, you shouldn't do the project because you will have a negative net present value project. Okay, so the advantage of the internal rate of return is knowing a return is very appealing because if I tell you I made $100, it doesn't really give you a lot of information, right? So what if this $100 profits based on $1 billion investment? That is not really interesting at all, right? The percentage of the return is very low. So if I tell you I made a 15% of the return, that tells you something, the magnitude of the return, right? And it is also a very simple way to communicate the value of the project with someone who doesn't know all the estimation details. And also, if the internal rate of return is high enough, you may not need to estimate a required rate of return, which is often a very difficult task. So we have a whole chapter, the cost of capital, at the end of the semester, showing you how to calculate the required rate of return, which is not an easy job. Okay, so if the internal rate of return is very high, you don't really have to do that anymore because you know this is going to be a very good project. But we also have some pitfalls of internal rates of return. The first one is the multiple internal rates of return. It shows you some projects could have more than one internal rate of return, means two or more different discount rates. The second one is it doesn't differentiate lending or borrowing. Finally, for the mutually exclusive project, you can't really use internal rates of return. So let's take a detailed look at each one of the pitfalls. So let's first take a look at the multiple internal rates of return and non-conventional cash flows. Okay, in our previous example, our assumptions are very simple. You make a one-time investment, which is a negative cash flow at say 0, and then in the following periods, you always have positive cash flows. But what if in the future you also incur a loss, negative number cash flows? Then you will have more than one internal rate of return. Let's take a look. Now suppose you initially invest $90,000 initially, and you will generate the following cash flows. First 2 years you have profits. Last year there will be a loss. Right? Suppose the discount rate is 15%. Should you accept or reject the project? Let's calculate the internal rate of return. Well, as you can see, by definition, internal rate of return is the discount rate that makes the net present value 0. But in this particular project, you have two internal rates of return, both 10% and 43%, can make the net present value 0 because it's a curve. Right. So now, should you accept the project or not? Well, when you have more than one internal rate of return, you should not use internal rate of return as an investment tool anymore. You only calculate the net present value and use the net present value as your signal to make the investment or not. Okay? So one more time, if you have multiple internal rates of return, more than one internal rate of return, most of the time in the real life, people will stop using internal rates of return. Okay, so the second pitfall is lending versus borrowing. Let's take a look at the following example. Project A and B. A, initial investment, $100. One period later, you get $150 back. Project B, $100 cash inflow, but in the next period, you have to pay out $150. When you calculate the internal rates of return, both of them will show you 50%. Well, when you calculate the net present value, assuming a 10.3% discount rate, the first project will generate a positive net present value, while the second one, of course, is a negative net present value. Because for project A, this 50% is your return. Well, for the project B, the 50% is the borrowing rate. So project A, you are making investment. Well, for project B, you're actually borrowing money, right? You get money first and then you pay back with the interest. The interest is very high, which is 50%. Okay. But internal rates of return always report you the 50%. It doesn't tell you whether it's lending or borrowing. If it's lending, making investment, which is super. But if this is borrowing for such high interest rate, this is horrible. Okay, so finally, for the mutually exclusive project. So first of all, what is a mutually exclusive project and what is independent project? Okay, so for the mutually exclusive project, it means if you choose one project, you cannot choose the other. For example, you can choose to attend graduate school at either Harvard or Stanford, right? So Harvard is project 1, Stanford is project 2. They are mutually exclusive because you cannot do both. You can only pick one. If you pick Harvard, you cannot go to Stanford. If you go to Stanford, you cannot go to Harvard. Okay, so those are mutually exclusive projects. You can only pick one. Independent projects means accepting or rejecting one project does not affect the decision of the other projects. Like for example, choosing between Harvard and Stanford versus choosing vacation destination in summer. Okay, they are independent projects, right? You can choose Harvard. At the same time, you can choose the vacation destination Disneyland, right? They are not mutually exclusive. You can do both. So that is called independent projects. Okay. So mutually exclusive projects, the scale problem. Now you have two projects to choose. One project pays you 100% return. The second project pays you 50% return. And they are mutually exclusive, means you can only pick one. Which one do you pick? Well, at first you may think, of course, 100% is better, right? But what if the 100% return is on a $1 investment, while the 50% return is on a $1,000 investment? Which one do you pick? Of course, now you will pick the 50% project, right? Because you will make $500 instead of $1, right? The magnitude problem or the scale problem. When purely talking about returns, yes, high return is better, but eventually at the end of the day, you need to know exactly how much dollars you're making. Okay. So now we have an example of the mutually exclusive project. Now assume both project A and project B have discount rate of 10%. Which project should you accept and why? Okay. So project A requires a $500 initial investment. Project B, $400 initial investment. Project A and B both have $325 cash inflow in the first year. Project A has $325 in second year. Project B has $200 inflow in second year. Okay. In this table, I calculated the internal rates of return and net present value for you. Project A has internal rates of return 19%, Project B 22%. Project A $64 net present value, Project B $60. Okay, so now tell me which project you want to pick. Remember, they are mutually exclusive projects, means you can only pick one. Okay, so which one you pick? According to the internal rates of return, project B is better, right? 22 is higher than 90. According to the net present value, project A is better, 64 versus 60. Which one you pick? You should pick project A, because at the end of the day, you're making $4 more than the project B, although the magnitude or the percentage return of B is higher. Remember our 100% versus 50% return example? You should always pick highest net present value project. Okay, so let me repeat the most important thing one more time. Whenever net present value and internal rates of return are giving you different signals, different conclusions, you always go with the net present value. You always pick the highest net present value project, because at the end of the day, you want to make more money instead of higher return. All right, so if we plot project A and project B, right, vertical line we have the net present value, horizontal line we have the discount rate. Now we have three critical points, crossover point on this picture. So first of all, the internal rates of return for project A is 19%, which is the red one. So the red one is project A. At 19.43%, project A has a net present value 0. The second important cutoff rate is 22%, which is the IRR for project B, which is the blue one. At 22%, project B has a 0 net present value. Okay, because the slope of the project A are different from the slope of the project B. So there is a crossover point, which is 11.8%. This is very important because this is the cutoff of people's preferences. Okay, so now suppose we have a company with the required rates of return of 5%. That company will prefer project A because project A will give you a higher net present value. But if we have a second company, the company's required rate of return is, say, 15%. then that company will prefer project B because project B gives you a higher net present value. Okay, at the crossover point 11.8%, then you will be indifferent between the project A and project B. All right, to sum up, net present value versus internal rate of return. Generally, they will give us the same decision. But whenever there is a conflict between the net present value and another decision rule, including payback period, discounted payback period, internal rates of return, average accounting return, you should always use net present value because it directly measures the increase in the dollar value to the company. And internal rates of return is unreliable when the cash flows are non-conventional, means the future cash flows are not always positive. Sometimes it could incur a loss in the future. In that case, you never use internal rates of return. And also, in the mutually exclusive projects, you do not use internal rates of return as a investment decision. Okay, so finally, the last investment decision is called profitability index. So the profitability index is the total present value of future cash flows divided by the initial investment. So if you pause here, take a look at this formula. Do you think this formula is very familiar to you? And you should. Because if you have your initial investment plus all the total present value of the future cash flow, what is that? That is exactly net present value, right? Your initial investment normally is a negative number plus the present value of all positive future cash flows. That is exactly the net present value formula. Okay, so the net present value formula shows you the dollar amount of profits, while the profitability index shows you the magnitude of the project. It shows you the profit per unit of cost based on the time value of money. Like for example, if you have a profitability index of 1.1, what does that mean? It means for every $1 of investment, you are creating an additional 10 cents in the value. Think about that. If your initial investment is $1 and the total present value of the future cash flow is $1.1, so the PI ratio will be 1.1, which means you are making 10 cents profit. So the minimum acceptance criteria accept the project if the profitability index value is greater than 1. Of course, you want your total future value higher than your initial investment, right? If the discounted future cash flow value is lower than your initial investment, you should never ever do the project. So the ranking criteria, if you have 100 projects with different PI, which one do you pick? Of course, the highest one. So here is a numeric example of the profitability index. We have two projects. Both require $1,000 in initial investment. The future cash flows are 7,500, 5,700. So how do we calculate the total present value of future cash flows? We discount the $700 and $500 at 10% according to the time period we received them. So the total present value of the future cash flows for project A for project 1 is 1050. For project 2, 1033. Okay, so the profitability index is going to be total present value of the future cash flow divided by your initial investment, which is $1,000 for both cases. Okay, so the PI for project A, 1.05. For project 2, 1.033. How do we interpret those two numbers? For project A, it means for every $1 you invested in the project, you are generating 5 cents profits. For project 2, for every $1 you invested, you are generating 3.3 cents. Okay. Well, according to the PI ratio, we should accept both projects because both of them are greater than 1. But if we can only pick one, project 1 is preferred to project B because PI is slightly higher, right? Because we're receiving the higher amount of $700 sooner than project 2. Okay. All right. So to summarize, in this example, we are going to use all 4 criteria we learned in the chapter. Look at project A and project B. Let's calculate internal rates of return, net present value, profitability index, and payback period. Okay. You can pause the video here and independently solve all the numbers. And then you can continue the video and see whether you have the same numbers as I did. Okay. All right. So we calculate the net present value, $42 for project A, $91 for project B. Well, for the internal rates of return, we're going to have 2 numbers. One is 0, another one is 100%. Because cash flows are not conventional. This is the conventional cash flows, means negative number for initial investment and all positive numbers in future cash flows. But if in the future the cash flows are not all positive numbers, they are called non-conventional cash flows. Then you will have more than one internal rates of return. PI 1.2 and 1.6. Please double check whether you have the numbers right. For the payback period, for project B is very simple, in 2 years, right? 50, 100, exactly 2 years, you get your initial $150 back. But for project A, it could either be 1 year or 3 years. See, in 1 year, you get back your initial $200 investment, but you also made sort of $800 investment in year 3, so maybe it's 3 years is also good, right? So you have 2 payback periods, 1 or 3 years. In that case, whenever you see unconventional cash flows means if there's a negative cash flow in the future, stop right there. Only use net present value as your investment decision. Never touch other investment decision tools, okay? When you have unconventional cash flows, net present value is the only thing you use. Okay. So we have some summaries for all the investment decision tools. You can just read them. We have already discussed them in details. And here we have some quizzes. You can pause the video here, individually solve all the numbers, and then turn to the next page and double check your numbers. I will skip them here. For the second quiz as well, pause right here. And then calculate your independent solutions. Check the numbers. Okay, so that's the end of this chapter. I hope you enjoyed the video. If you have any questions, please feel free to email me and I will get back to you as soon as possible. So thank you. I will see you next week. I will talk to you next week.